2015 Reuters Global Investment Outlook Summit. I'm joined by Greg Peters, Senior Portfolio Manager at Prudential Investment Management. Good to see you, Greg.
Good to be here.
So as we're heading into 2015, what are your thoughts in terms of where interest rates go, courtesy the Fed or not, in terms of the 10-year? And what's your view of the economy as well for 2015?
Yeah, so I still believe the economy is very much in this 2.25%, 2.5% type of zip code. I don't really see a breakout here in the U.S. Either to the upside or really, to the downside. The bias is always to the downside, though, and we're up against this global economy that is slowing. So I just think that's a constraining factor. Well, as far as rates and the Fed are concerned, I think rates are pretty stable. The 10-year stable. If anything, they'll gently move lower, not higher, over the course of the year. And the Fed, the way I'm thinking about the Fed is really later, lower, longer. And so I think the bias there is that the Fed will raise rates later in the year, if at all, and rates will remain lower for longer. And even if I'm wrong about the later piece, I do believe that rates will remain low.
You made a very great point at our Reuters Summit, and that is this end of QE, or this moving the baton from one central bank to the next, is something that you're thinking a lot about and potentially worried about.
Absolutely, and no one's really talking about it. It's crazy to me. But essentially, you have this massive handoff from the Fed to the ECB and the BOJ at a time when the law of diminishing return around QE is lower and lower and lower. So it's that much harder for the ECB and BOJ to have the same kind of effect that the Fed initially had. And so I think there's a lot of pressure on those central banks to get it right, and the markets to behave well as a consequence. So I actually think it's a very big deal and way too much comfortability around that handoff, in my view.
So we know that in 2014 it was a huge chase for yield. Does that mean, given that the scenario on interest rates might not change much in 2015, we still see that rush to yield and high yield and other such products?
Yes, I believe that yields will remain low, and so investors need stated yield, and that will constantly and help kind of this bid for yield in the marketplace. So I believe that investors will continue to want to own yield product.
Do you like high yield?
I do like high yield, and so we put a bunch of high yield risk on in October after the flash crash. I still think it makes sense, but I think it'll be much more volatile in the upcoming year and much more specific around areas that you want to avoid.
You also like structured products.
I do. Structured product, in my view, still has the best risk-adjusted reward out there. So we like top of the capital structure. I feel like it's fundamentally safe. It's cheap relative to other parts of the capital structure, and we like it a lot. And it actually has pretty good liquidity characteristics as well, so we feel very comfortable around that as well.
You are concerned about liquidity in the fixed income market too.
Yeah, liquidity has continued to decline. Post-crisis, it's a very different marketplace. I think you need to recognize that fact and accept it and manage around it. And so the way we're managing around it at Prudential is we're keeping our risk not at the max but lower, a little more liquidity, and only owning names that we fundamentally believe in because we know that we'll have to own it through the cycle. So you can't trade out of it. You basically own it. And I think that's an important distinction.
What's your view on investment grade debt next year?
Investment grade debt, I still like financials. There's a ton of supply this year that really cheapened up the financial sector. Hopefully that'll normalize next year. The industrial space, a lot less excited about. I think event risk is on the rise continually, and so I really don't like the industrial space. So investment grade, I don't love. But I like the financial side of it, but the rest of it, I'm much more blasé on.
Anything you just flat out dislike?
Nothing I flat out dislike necessarily. I would say there's pockets of richness, though, and I would say that's in Europe. And so European credit looks rich to me relative to the U.S. If you look at how that market traded versus the U.S. over the past couple of months, it continued to richen, where the U.S. has cheapened up. I think fundamentally they're much more levered, and it's basically putting a lot of onus on the ECB. So I worry about that. So I'm much more in favor of U.S. credit at this point.
Greg Peters, great to talk to you.
All right, thanks for having me.
I'm Rhonda Schaffler. This is Reuters.